Good morning, and thanks so much for tuning in. You're watching Trade Talk on BQ Prime. My name is Alex Mathew. Now, based on what we're seeing right now across the globe, the chances are that the Indian equity markets will continue to see selling, and we could well see the sixth straight day of losses for the benchmark indices for sure, and for the broader markets in all probability. Now, we are, despite that kind of selling, only about 5% or thereabouts away from all-time highs. So the corrections have not been as sharp. And for the broader market indices, and I'm talking about the mid-cap 150 and the small-cap 250, the drop from that all-time high is about 6 to 7% as well. Now, based on the GIFT Nifty and where it currently stands, the indications are that we will open gap down and we will open around that 19,050 mark. Whether or not we hold on to that 19,000 level on expiry day is something to bear in mind as well. Now, from the global perspective, there are a couple of things that you need to bear in mind. On the one hand, you have the NASDAQ, which dropped the most in 2023, and that's largely a tech-driven sell-off, where you saw Alphabet, which disappointed the street, particularly when it came to its cloud business. You have Amazon results that will be out later today, and you will also have the US GDP numbers that will come out, and that could have a bearing on treasury yields, which have been very volatile of late. Even in this week, it is back up close to that 5% mark for the 10-year treasury yield right now. So let's get you also set for all of the cues that you need to bear in mind on expiry day for the current month, that is for the month of October. Agam Vakil is joining in to tell you just that. Agam, morning.
Good morning, Alex. Well, a bunch of things that we'll be watching out for. One is that in terms of the relative strength in index, that's coming in at around 30. Now, usually, over the past, many years, what we've seen is that every time the Nifty tests the 30 level on the RSI, we see that as a little bit of a bottoming out. Besides that, we really haven't seen too much in terms of additional short positions when it comes to FIIs, at least in the index futures. So these are the two factors that just may play out in favor of a little bit of a pause in the kind of correction that we've seen. That said, we are seeing a substantial pickup in rollovers as far as the Nifty is concerned, and this is towards the short side, certainly. In fact, rollovers are already at around 63%. I reckon if this number moves to around 85%, and the majority of that does happen in today's day of trade, considering it's the monthly expiry, we're likely to test 19,000 once again over the next few days. But 19,000 remains a psychological barrier, along with the fact that it also has maximum open interest in the put side. So it is also going to serve as a little bit of a support. How strong it is? Well, today's day of trade can actually determine whether or not we can hold on to that level. And finally, coming down to the Bank Nifty, again, of course, a lot of activity has shifted lower. So we are keeping an eye on 42,000 put. That's where the max OI is. And 43,000 thereabout is what we're keeping an eye on the higher end, considering we saw the Bank Nifty break that level, which was very crucial, Alex. So watching out for that as well.
Certainly. Now, earnings is also, or rather reaction, Agam, to earnings is going to be critical to watch, particularly from the IT pack. You have Tech Mahindra, which posted a disappointing set of numbers, to say the very least.
Right.
Miss on all fronts, revenue as well as the PAT number and the EBIT number. In fact, my colleague Tushar spoke with the management to kind of understand what the reason for these numbers were, and also to look at the outlook going forward. We've got Mohit Joshi, who is the Managing Director and Chief Executive Officer Designate of the company, and Rohit Anand, the CFO, speaking to Tushar. Listen in.
What explains this plunge in profit that we have seen in the second quarter?
Yeah. So I think from a profitability perspective, the first of the operating impact is driven because of revenue decline. We're seeing continuous discretionary spend cut in the industry, and specifically on the comms side, a little bit also in the BFSI space. So that's causing a pressure on the profitability side, including utilization and some of the other operating metrics. Around 260 basis point quarter-to-quarter margin decline is, or 2/3 of the drop can be attributable towards one-time actions that we've driven internally. So we're looking at portfolio focus on what we want to drive for the future and defining the core as a part of that. And hence there's a identification of regions, service lines and contracts which doesn't fit that risk and reward that we want to drive for the company, and hence we've taken one-time actions for that. We'll continue to do that scrutiny for the next quarter as well before we set the core and define the core for us, and then come back sequentially to all of you guys to share a plan towards an April timeframe. Yeah.
Against that backdrop, what explains the margin decline as well? How do you plan to shore up the margins here on for the rest of the fiscal? Do you have a target in mind? Where do you want to end the year at?
Yeah. No, I think as I mentioned, we'll share the detailed plan with all of you guys with April. But when you look at historically, we've operated at a double-digit EBIT number. We've been at that mark. There's at a lower revenue as well. So it's not that we've had higher revenue and that's caused the decrease. But I think from a plan perspective, specifics, detailing, I think all that's work in progress. We know some of the areas that we had already started to act upon, but I think it's be prudent for us to come with a comprehensive plan collectively from the management and share with you sometimes in April. Yeah.
Mohit, welcome to PQ Prime. I think we are talking for the first time in person. Yeah. So you have effected a restructuring plan that will come into effect from 1st January. Can you take us through the entire process and what is the aim of such a restructuring?
Sure. So, it's not really a restructure, it's a reorganization of the company. Like you mentioned, it has now been about 4 months since I joined TechM, and more than halfway through the process of transition with the current CEO, CP Gurnani. CP leaves on the 19th of December. But as CP and I and the rest of the senior leadership were talking about the shape of the organization for the future, a couple of things struck us, right? The first thing that had struck us was from a delivery perspective, a consolidation of delivery would really help us drive resilience, drive an improved margin structure, and help us drive a greater service line innovation. So one of the key sort of driving factors behind the reorganization has been consolidating our IT services delivery under a new chief operating officer. I believe this will help us unlock a tremendous amount of synergy and a tremendous amount of growth potential. Just historically, for instance, our engineering service line, which is such a core driver for us, such a unique differentiator for us, was split between our telecom business, our manufacturing business, and some of our Eastern European location, right? So by bringing all of that together into one engineering practice, we feel we can unleash a lot of energy. Similarly, on the go-to-market side, we had a fragmentation of our sales units between telecom and non-telecom businesses. We have consolidated this in Asia, Pacific, and Japan, and in Europe. In the Americas, we now have a very clear sort of vertical-driven go-to-market structures within North America. So, taken together and with a couple of senior hires that we brought into the market from a BFSI perspective, from a marketing perspective, I feel that we can drive, again, resilience, margin improvement, faster growth, and service line innovation.
Do you think this is the right time for you to dilute your revenue pool a bit more or expand the revenue pool a bit more? Given for the fact that you come with the reputation of being the BFSI guy. So do you think this is the time for Tech Mahindra to push into that particular space, especially when it accounts for almost more than a third of the entire industry's revenue?
Yeah. So look, I think if I take a look at the Tech Mahindra revenue, right? So first of all, Tech Mahindra is Tech Mahindra, and as our new CEO once very eloquently said, that what we want to do is to make Tech Mahindra the best version of itself. Yeah. We're not looking to make this into Accenture, not looking to make this into a TCS, right? From a industry perspective, clearly we have deep strengths in manufacturing and deep strengths in telecom, and we really want to make sure that we're able to double down on this. As you know, in manufacturing, in auto and aero, the group has a tremendous heritage. The Mahindra group has a tremendous heritage, so really want to focus on it. We do have $1 billion plus BFSI practice already, right? Yeah. And I believe that we are very credible challengers in this space. We have a very significant healthcare practice, and we really want to drive growth in there. So now the idea is not to convert this into a BFSI consulting firm. The idea is very much to double down on the strengths we have in manufacturing and telecom, but equally to build out a much larger healthcare, BFSI, and a retail practice.
There you go. That was the management of Tech Mahindra. Don't be surprised based on the current scenario and the sentiment that you see considerable selling pressure on Tech Mahindra in trade today. Now, from a not so good result to, shall we say, a good result, because Axis Bank was the last private sector bank, major private sector bank, to post its results for the second quarter. And it has checked all of the boxes. Himansh is here to tell you about those very boxes. Himansh, asset quality improvement, NIM in line, PAT in line, and core income in line. So it's hit all of the marks.
Absolutely. Like you said, it's checked all the boxes. What's there to say really? Because even in my review, brokerages were expecting them to report healthy numbers, and that's what Axis Bank has done. Profit jump of 10%. Net interest income that's up over 20%, and gross NPAs, net NPAs down 26 basis points sequentially. Net NPAs also showing significant improvement. So the key positives here that a lot brokerages, as well as when I went through the results, found out was that core NIMs, which were just down 1 basis point quarter on quarter, was a key positive, because brokerages were expecting NIMs to be compressed over time, especially in this quarter as cost of funds and cost of deposits catch up. Now brokerages are expecting the net interest margins to be sustained at these levels, and they also expect operational expenses to moderate in the near term, which will aid in improving the pre-provisioning operating profits of the company going forward. Especially on a consolidated basis for Axis Bank, there was a very strong performance noted from the subsidiaries, especially Axis Capital, which reported a 77% jump in its profit growth. Valuations are looking attractive, with Axis Bank trading at about 1.5 times its FY25 price to book, and which is at a 25% discount to ICICI Bank. Another key interesting takeaway here is that the net interest margin differential between ICICI Bank and Axis Bank, which hovered around 68 basis points between the last quarter of the last fiscal and the first quarter, has narrowed down to 26 basis points from 68 basis points, and brokerages are expecting this differential to further narrow out. And as this differential narrows, it will reflect in the performances and perhaps in the valuations as well, presenting scope for re-rating.
Certainly. That's certainly something to watch out for. Thanks so much, Himansh, for bringing us those updates on Axis Bank's one of the counters to watch out for in trade. There are several, though, on the back of earnings. Lots more to talk about. And Varsha is joining in with her list of stocks that could react on the back of earnings. And we're starting, I believe, with Jubilant FoodWorks. Now, the question is, Varsha, you've probably been eating less pizzas because the company's missed its estimates.
That's what I was going to tell you. Let's see if this pizza tastes good. So, as you rightly said, so Jubilant FoodWorks came out with its Q2 results, and it saw its quarterly profit decline, missing analyst estimates on the back of heightened local competition and weak demand. Also, the standalone net profit of the company fell 40% year-on-year at rupees 72 crore. Now, during the quarter, company saw 1.3% drop in like-for-like sales, which is actually important for this business over the previous year, also marking the third consecutive quarter of decline as price-conscious consumers are tightening their belts due to inflation. Now, Domino's revenue from the delivery channel, which comprises almost 65% of sales, rose 7.9% year-on-year, and revenue in the dining segment, which accounts for almost 34% of sales, was lower by 3.8% over the previous year. Now, the degrowth is because of decline in tickets and orders due to temporary closure of stores undergoing re-imaging. Then next we have Sona BLW Precision, where revenue was up 20%, while EBITDA margin was at 27% versus 24%. Now, the good thing about this company is, if you see, there was a 58% year-on-year growth in battery electric vehicle, and the net order book grows to 221 billion, which is 8.3x of FY23 revenue. Also, battery EV as on H1 FY24 is 27% of revenue versus 14% in FY21. So this is actually really good, since we are seeing huge growth in battery electric vehicles. Then we have Charlotte Hotels, where revenue was up 26%, and the average room rate was at 9,610, up 21% over Q2 FY23. Also, occupancy was at 73%, expansion of 2% points over Q2 FY23. And revenue per available room improved by 25% year on year. And if you see, PAT was up 2.3 times at 36 crore versus 15 crore last year. Then we have Chennai Petroleum Corporation, where revenue was down 12%, but EBITDA was up 7.8x. Now, margins were at 10% versus 1% last year due to decrease in cost of material. So, huge uptick in margins. Also, PAT was 70.6 times up, which was led by operating profit, of course, and there was increase in other income by 2.5x. So, this we should note. Also, the next company that we have is Rallis India. We all know what is happening in agrochemical sector and seeds business. So, though the revenue was down 12.52%, this was led by weak demand due to inventory overhang and low prices. So, prices remained soft. Also, the crop care revenue was lower by 20% due to weak exports demand and price drop across products are the key reasons. EBITDA margin was 15% versus 12%. Margins were protected though through improved geography and product mix. And PAT was up 13%, which was led by reduction in finance cost on account of debt reduction. Then we have Banari Aman Sugars, where revenue was up 18% and EBITDA was up 35%. If you see, PAT was up 80% as there was 46% decrease in interest cost. Then we have Gulf Oil Lubricants, where you saw a growth in revenue of 11% and company crosses milestone of rupees 100 crores EBITDA in a single quarter for the first time, which was up 25%. Now, EBITDA margin was at 12% versus 11% last year, and the quarter witnessed reasonably stable input cost, which was seen in EBITDA margins, which helps better material margins and better product mix across segment. And lastly, we have Indus Towers, where revenue was down 10%, but EBITDA was up 22% and margins were at 48% versus 35%. Now, company saw a huge decrease in other expenses. Also, PAT was up 48%. As on September 30, 2023, the company operated total of 2.04 lakh towers, which was higher by around 16,000 as compared to 1.88 lakh towers operated in the year ago.
Okay, all right. Thanks so much, Varsha, for bringing us those updates. A few very key stocks to watch, of course, Jubilant among them because of the disappointment in the results. But let's focus in on FMCG next, and we've got Nestle India to talk about. And Sessa is joining in to give us some perspective on what I believe, Sessa, was the first in-person investor meet that the management has done here in India, and that took place in New Delhi. And there were statements that were made about the volume growth going forward and the pricing, which has been a key focus for Nestle. The fact that there are local companies that are eating into its market share because it continues to raise prices.
Yeah, that's right. So, the product price, the company has raised product prices significantly across, like half of its portfolio has seen price hikes. However, the company does not, see rolling back of these prices, even as the competition, heightens in categories like noodles as well as coffee. Now, the company says that the raw material prices, is a mixed bag with prices of green coffee and cocoa still elevated. So that way, the price, in terms of pricing, the company does not, will not look at reducing the prices, at least in the near term. Now, during the investor call, Mr. Narayanan also said that the endeavor is to grow the company faster, or at least maintain the 7% volume growth that it has seen in the last 5 years, owing to the capacity is being built by the company, be it on the manufacturing side or even the supply chain side. Now, among the categories, the management expects both the core as well as the newer categories to continue to grow with the focus to remain on the wider definition of health and nutrition. The company has 10 new projects in the pipeline. The longer term objective of the company is to take innovation as a percentage of sales contribution to around 10% from the current 6%. The management also did highlight that the growth will be balanced with profitability, and the company will refrain from entering categories that are margin dilutive. In terms of inorganic expansion, the company said that M&A is now a focus. Remember that Nestle has been a top contender for Ching's Secret. So there are other players in the fray as well. So Nestle is competing with Tata Consumer in this space. So we need to watch this space. Also, over the last few years, the company solely focused on organic growth. So now they are scouting for acquisitions, although right fit and the capability to add value and valuations are must.
Interesting. And certainly, again, a stock to watch, not just today, but in the near term as well. We've got Asian Paints also that will be reporting its numbers, Sessa. And here's another category or segment of the market that is seeing increased competition, new players entering the fray. But this is an incumbent which holds a lion's share of the market. What are the cues and what are the key numbers to watch when it comes to Asian Paints?
Right. So other than competition, the Asian Paints is also expected to report subdued demand due to the late festive season and the irregular monsoon. However, it is likely to report strong margin expansion during the second quarter. Now, the street estimates the decorative paint volumes to grow about 7% year on year in Q2. This is on the back of market share gains and premiumization trends. The street also expects the value growth rate to taper down given that the absence of pricing growth. In terms of key raw materials, we have seen titanium dioxide and crude oil drop on a yearly basis. However, the crude prices flared up about 10% on a quarter-on-quarter basis. So concerns on skyrocketing crude prices still remain that needs to be watched out for, and also the impact of patchy rainfall on demand and the festive season pickup and the impact that it will have on the performance of its home decor segment will be the important factors to track.
All right. Thanks so much, Sessa, for bringing us those updates, and we'll touch base with you once again once the results are out. Let's talk about the other stocks that you need to watch out for in trade. And very quickly, Rishi is joining in with a whole list of stocks. Rishi, what are you picking up, apart from earnings, I'm guessing?
Yeah. So a couple of stocks. Firstly, the Samvardhana Motherson, where it has initiated an operational reconfiguration of a few European units. Now, the context is that it has done a lot of investments and acquisitions over the past year since September. And the proposed configuration will lead to a cost-based rationalization. Effectively, it is going to lead a one-time cost of up to 30 million euros. Then we have Karnataka Bank, which has entered into a partnership agreement with Vakrangi. The partnership is to provide a business correspondent banking services, and these services will be offered through Vakrangi's Kendra outlets, and this will be across India. Then we have SH Kelkar and Company, where the company has invested £4.99 million in an European subsidiary by subscribing 1.39 million shares at 3.6 euros per share. Then we have a whole host of fertilizer stocks that you need to look out for, because the cabinet yesterday has approved a 22,300 crore worth of fertilizer subsidy for the Rabi season. But this subsidy is much lower than what was offered for the Kharif season. For example, for nitrogen, the subsidy stands at 47 rupees per kg compared to 76 earlier. Similarly, for phosphorus, it's at 21 rupees per kg compared to 41 rupees earlier. So the stocks that you need to watch out for are fertilizers and chemicals, Travancore, Chambal Fertilizers, Rashtriya Chemical and Fertilizers, National Fertilizer, and Paradeep Phosphate. Now, these companies are already facing rising costs with hardly any respite in terms of prices. Now that subsidies have come in even much lower than what was expected and compared to the previous season, these stocks already reacting negatively towards the last few minutes in trade yesterday after the news came in. So they may continue to see some correction as we go into trade today.
Certainly. It was towards the last few, in fact, last half an hour or so where we saw that update. Let's also talk about action in the primary markets. I know it's a little bit of a sentiment worry that they have based on the current scenario, but what can you tell us about the latest action?
So there is IRM Energy, which is going to list on the exchanges today with it had an IPO price band of 480 to 505, and its issue size was 545.4 crores, and it was a 100% fresh issue. It was subscribed by over 27 times, with anchor investors subscribing to about 160 crores of the overall issue. Then with regards to its business, it is a city gas distribution company in India with operations in Gujarat, Punjab, Daman and Diu and Tamil Nadu, and it is engaged in the business of laying, building, operating and expanding the local natural gas distribution network. A quick snapshot of its financials: its revenue has grown almost 5x over the past 2 years, but profits have only doubled, with margins currently standing at only a third of what it was previously. Now, it is therefore important to look out for how the profitability and the numbers pan out over the upcoming quarters and financial years. Then a quick look at its peers as well. Its peers would include Gujarat Gas, Indraprastha Gas, Mahanagar Gas, and Adani Total Gas. The IRM Energy will have a market cap of approximately 2,000 crores at the upper price band when it lists, and it has a PE of about 24, which is much more expensive than all of its other peers except for Adani Total Gas. So we'll have to see if this expensive valuations are justified given that it is a relatively small company. Apart from that, we also have an IPO that is currently open for subscription, that is Blue Jet Healthcare. It was subscribed by about 0.69 times on the first day of trade, on the first day yesterday. Then its issue closes on 27th October and its total offer size is about 814 crores and the IPO price band is 329 to 346.
Thank you so much, Rishi, for bringing us those updates. But more than action on the primary market front, it's going to be the secondary market that you'd want to watch very closely because as things stand, as I mentioned at the start, we're likely to see another day of cuts, the sixth straight day in a row. We'll bring you all of the action live, so do stay tuned. This is BQ Prime.